Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'm going to talk about superannuation returns for the 2022-23 financial year just finished at the end of June 23, of course. And as I do every year, I talk about how different industry funds have performed and give you some insight into some of the things that I consider when contemplating which fund I think might be the best. And then at the end of today's episode, I will give you a conclusion of which fund I do actually think is the best. So despite a pretty tumultuous year in share markets, and it's certainly a very rocky road, returns for 2023 financial year were actually finished above average, and mainly due to a very strong finish. So the last 3.5 months, for example, international markets rose by 12% over that period of time. So without that sort of rally towards the end of the financial year, it probably wouldn't have been as good a year as it was. So I've got a table, link to the table in the show notes, of course, but I've prepared two tables, one for the best balanced options and then one for the best growth option. And the growth options really defined are the option that gives you the greatest exposure to share markets. Balanced options tend to have somewhere between 60 and 76% of their allocation towards share markets. I know that's a big range, but that's how they sort of define balanced. And essentially UniSuper delivered the highest return last year, highest balanced return last year at 10.34%. And the worst of the top 8 industry funds was Hostplus at 8%. So there's about a 2% differential between the highest return and lowest return of those top 8 industry super funds. If we look at growth, Australian Retirement Trust delivered just shy of 15.3% for their growth return. Aussie Super wasn't too far behind them, about 14%. And the worst high growth performer was Australian Super at 10.5%. So again, just for last financial year, the range is really 10.5 to 15.3% for growth options. Now, if you have a look at longer term returns, UniSuper is the best over 7 to 10 years for growth. And Hostplus was the best over 7 to 10 years for balanced. So 8.5 to 9% for balanced over that longer term period, where 10 to 10.5% for growth. So of course, returns can jump around a little bit, and it's not possible or likely that the one industry fund will be at the top of the table for all those periods, whether it's a short-term 1, 2 or 3 years or 7 to 10 years and so forth. It will jump around a little bit, but of course it makes sense to focus on longer term returns because you really want that sort of longer term performance. And certainly UniSuper is certainly up there with them from an overall performance perspective, and so is Australian Retirement Trust. So I wanted to spend a few minutes now talking about some of the concerns that I have with respect to industry super funds. So if we're investing or putting a lot of our retirement savings in a super fund, which most people are, of course, then we want to make sure that that money is invested safely and wisely and prudentially. So I just want to take a couple of minutes to talk about some of the concerns that I have. And the first one is the valuation of unlisted assets, which has actually garnished a lot of attention over the last 6 months in the financial press. And there's a lot of articles, in fact, that I've saved. So if you're interested, I can always share them with people, listeners. But and I have written about in the past and also spoken on this podcast about how opaque the industry super fund investments are. In fact, there's very little reporting around them in terms of which investment managers they're hiring and firing, what unlisted assets they're investing in, how they're managing those. It's really a bit of a black box, if you like. And interestingly enough, an independent statutory body called the Financial Regulator Assessment Authority released a report into APRA, which regulates the industry super funds, and said, and I quote, "It's taken a reactive and immature approach to scrutinising super fund valuation processes, putting Australia's retirement savings at risk. And the regulator has heeded those warnings, APRA that is, and told the industry super funds, hey guys, we're going to pay closer attention to this. But really, I mean, they should have been all over it. And, you know, there's certain obligations for a listed company. If you're a CBA or, you know, Myer or whatever it might be, if you're a listed company on the Australian Stock Exchange, there's certain obligations, disclosure obligations that you have. You've got to tell the market about certain things, and it creates a very efficient market because people can assess, or at least to a greater extent, assess the risk associated with investing in a particular stock. Well, similar sort of disclosure obligations, I think, should be incumbent upon the industry super funds because we're putting our retirement savings in them. And whilst the average Australian might not have enough knowledge and experience to look through or consider that information, certainly the financial press will, and also certainly financial advisors will, and it will make for a much more robust industry. And so unlisted assets and the valuation of unlisted assets has been, you know, one of the big things at the forefront in regards to this. And if we have a look at, you know, how industry super funds have valued commercial office towers, for example, and I mentioned commercial office towers because there's been, and I did an episode in May talking about commercial property and its challenges. And the challenges it's had over the last year is, you know, interest rates are up 4% in Australia, 5% globally, sort of around the world. So, you know, cost of debt associated with these sorts of ventures has increased. Work from home has had a big impact on vacancy rates and even demand for space within commercial office towers. So just those two things, I mean, there's a lot moving around, but even just those two things suggest that, valuations are really under pressure. Anyway, so I tracked what the press were saying about this, and I've got a list of, what or how certain industry funds responded to this. So Australian Retirement Trust revised their valuations down by 15%. This is just for commercial office towers. Australian Super down 10%. Aware Super down only 5%. And CBUS down about 10%. So they're the ones that have been talked about in the press. And as I said, I've saved those articles. So it's possible that, you know, individual assets will perform differently and hold up differently under different conditions. So it's possible that, in fact, some funds have only revised their valuations down 5% and some by 15%. It's a very wide range for a market that's been influenced by some of the same criteria or some of the same factors like interest rates and vacancy. The point is that it's just impossible to assess whether there's a lot of risk in those portfolios, whether the valuations are conservative or bullish, and whether it's a good place to put your money. And that's the kind of the point that I think the regulator and the oversight body has been making, is that there needs to be more transparency and accountability here, although I'm not that optimistic. Because last year the Albanese government proposed 2 changes to industry super fund disclosure rules. The first one, it was seeking to remove the obligation of super funds to provide an itemised list on what they spend their marketing budget on, and payments, and including payments to unions. Now the industry funds don't need to give that itemised disclosure. They just need to give or disclose an aggregate amount to members. And apart from member education, I fail to see how things like advertising on TV or sponsoring a union event helps boost retirement savings for existing members. Of course, it attracts new members and therefore cements, the existing employees' jobs. But what does it do for the people that are already a member of that fund? Because certainly there's been no scale. There's certainly been no economies of scale with the industry super funds. I mean, fees have been rising, not going down. With scale. So the argument could be that they could make is, well, the more members we have, the cheaper we can deliver our service. But that's not true. Anyway, I think if I was an investor in an industry super fund, and I'm not, I would want to know where my money's going or what that fund is spending money on. And if they're going to just waste money on certain things, then I will take my retirement savings elsewhere. And I think those disclosure obligations that the coalition government, I'm trying to be apolitical here, but the coalition implemented those obligations, and now the Albanese government has wound it back. The second change the Albanese government wants to make is they want to abolish the requirement for industry super funds to disclose political donations. And again, this is something the coalition legislated. The Electoral Commission data confirms that industry super funds have donated over $85 million to political entities and associates over the last 5 years. So that's some of your retirement savings are going as being used for political donations. And as far as I could see, this change has actually received a lot of opposition from the Greens, the Coalition and the Independents. And I don't think it's been passed. I did a lot of searching around. It looks like that bill hasn't been passed yet. So at least that's good news. But as a multi-trillion-dollar sector, you would think that disclosure obligations should be increasing. The amount of oversight by both government and just the industry as a whole should be increasing, not reducing. But it seems like the current ALP government is keener to reduce these obligations rather than increase them, which I think muddies the water. And, I'm not suggesting that there's problems within the industry super fund sector, but I know that we all know that problems thrive in the dark. And transparency and accountability are really the best antidotes to any potential problems. And so if everything is being managed well, then certainly the industry super funds shouldn't have any problem disclosing that fact. So another observation I'd like to share is that perhaps high growth investment options are better or more suitable for people to invest in super. And there's two reasons for that. Firstly, if you have a high growth investment option, a greater proportion of your retirement savings will be invested in listed stock markets and less invested in these unlisted investments, which, no one really knows anything about. And so if I was investing my money, I'd feel a lot more comfortable if it was invested in listed share markets, because then it gives me a really good sense of what the underlying performance is and also the underlying risk. The second observation is that really in the long run, growth assets such as listed shares will generate higher returns than defensive assets like bonds and infrastructure and these sorts of other sub-asset classes. And so if you're a long-term investor, so that is if you're less than 50, which means that you're 10 or more years away from being able to access your super, then it's very likely you'll be better off by investing more in growth sub-asset classes. Now, the traditional wisdom with financial planning is to have a really diversified asset allocation that gives you exposure to many sub-asset classes to reduce your portfolio's volatility. And whilst it might actually do that, as in reduce your volatility, it also reduces returns. Therefore, if you can just make friends with higher level of volatility, that means that your super balance will rise and fall by substantial amounts, maybe from month to month, probably less so from year to year, and certainly not very much from 5-year periods to the next 5-year period. But if you can make friends with some more volatility, then it's likely you'll be much better off, 1 to 2% per annum better off, by investing a greater proportion of your balance in the share market. Now, there's two exceptions to this. Firstly, if you don't have the stomach or risk appetite for higher volatility, then don't do it. No point losing sleep at night over these things. And secondly, for some people, capital preservation is more important than investment returns. And so for those people that are closer to retirement or in retirement, a more conservative asset allocation is probably more appropriate. But given how bonds have performed terribly over the last couple of years and not done what they should have done, which is create some negative correlation with share markets, I'm starting to think more and more that people will be better off just putting all their money in the share market and in some way ignoring other asset classes, particularly if you're very young and you're going to be investing in super for the next, say, for example, 20 years, you'd be much better off to take that asset allocation. The next thing I want to talk about is that percentage-based fees are the enemy of anyone with high superannuation balances. So the economic challenge that industry super funds face is they have millions of individual members with very low balances. So as such, they need to charge fees on a percentage basis because those members with low balances couldn't afford to pay higher fixed fees. And so consequently, members with higher balances end up subsidising those with lower balances because they're paying the lion's share of the investment costs. And that's just unfair, of course, if you're a member with a high balance. Now, most industry funds have two types of fees. Firstly, an admin fee. It usually consists of, maybe $1.50 or $2 a week, plus maybe a small percentage fee. But admin fees are relatively low, somewhere between $200 and maybe $1,000 a year, something like that. The second fee is an investment fee, and that's almost always a percentage-based fee. And I've listed the fees in a table on the blog and the website, which you can see, but really for balanced investment options, they range between 0.5% to 1%, and for growth, they range between 0.6 to 0.9%. For example. So on a percentage basis can be quite significant, particularly if you have a high balance. So for someone with $500,000 invested in super, they're paying $4,000 a year in fees, and you'll pay more each year as your balance grows, which doesn't always make a lot of sense. So by comparison, our client portfolios, for example, that we manage from a superannuation perspective, the weighted average cost is 0.3%, so a lot lower than these industry super funds, sometimes a half to a third as much as these industry super funds, and they really do suit people with higher balances. So, for example, someone with $1 million will save $5,000 a year just in fees alone, and notwithstanding, I'm happy to say that those portfolios have performed better than the average of those industry fund returns as well. So, fees are guaranteed, returns are not. And those people with large balances with industry super funds might be better off considering going to an environment that offers them lower percentage-based fees, because as their balance grows, so will the dollar value of the fee paid. Okay, so let's sum it all up then. Overall, I think UniSuper is the best industry super fund, and I think that for three reasons primarily. Firstly, the returns have been very strong, if not at the top, very close to it in terms of its peers. Secondly, invest the least amount in unlisted assets. So, for example, of its high growth option, 94% is invested in listed share markets, and that makes me feel pretty comfortable. And third and finally, it has the lowest percentage-based investment fees, which I think is really important, again, particularly for those people with higher than average balances. Now, of course, this isn't personal advice. You shouldn't go out and switch a super to UniSuper just off the back of this podcast episode. You should go and get your own personalised advice, because there could be a lot of other important matters that I haven't considered or discussed in this blog, such as insurances and so forth. Okay, if you'd like to know more, refer to the blog on the website. That link is in the show notes, of course. And until next week, bye for now.